Here is a question that almost nobody in the covered call and income ETF space asks out loud, even though it is probably the most important accountability question you can apply to any fund manager. Do the people selling you these products actually own them? When a portfolio manager stands in front of a camera or publishes a fund fact sheet telling you that their covered call ETF will generate life-changing monthly income, pay for your retirement, and deliver consistent distributions through every market environment, are they putting their own money where their marketing materials are? Or are they collecting management fees, earning a salary, and driving to the office in a car paid for by your expense ratios, while their own investment account holds something completely different? The income ETF space has exploded over the last 3 years. Covered call funds, option premium strategies, leveraged income products, synthetic distribution vehicles, thousands of new launches aimed at investors who want high monthly yields and are willing to pay elevated fees to get them. Some of these products have been genuinely excellent, many have been genuinely destructive, delivering enormous headline yields while quietly eroding the NAV that the yield is calculated against, leaving investors with less money than they started with despite receiving all those attractive monthly distributions. The investors who got hurt worst were often the ones who trusted the marketing without asking the harder questions. And the hardest question of all is also the simplest: does the person managing this fund own it themselves? Today I'm going to answer that question for 18 covered call and income ETFs across multiple issuers, NAOs, JP Morgan, TAP Alpha, Amplify, X-Funds, and First Trust, using Morningstar's publicly available manager ownership database. This data is disclosed because regulators require it. Most investors never look at it. We are going to look at every single number, walk through what each manager owns, calculate the total skin in the game across the full list, and then have an honest conversation about what these numbers tell you and what they do not. Before we start going through the numbers, let me explain the Morningstar ownership database and how it works, because the methodology matters for interpreting what you are about to see. Under SEC rules, fund managers of U.S. registered investment products are required to disclose how much of their own money they have invested in the funds they manage. This information is filed annually and is accessible through Morningstar's fund research platform. The data is reported in ranges, rather than exact figures. The disclosure categories are $0, $1 to 10,000, 10,000 to 50,000, 50,000 to 100,000, 100,000 to 500,000, 500,000 to 1 million, and over $1 million. These ranges are disclosed at the time of most recent filing, which is typically at fund launch or at the most recent annual update. For newer funds, the ownership numbers reflect early-stage positions and may not capture subsequent additions the manager has made as the fund has grown and appreciated. Throughout this video, I am going to use the upper end of each range as my estimate, because for funds that have been running for multiple years and have appreciated in value, the lower bound understates what the manager likely owns today. If a filing shows a manager owned $10,000 at launch, and the fund has returned 30% since then, their position is worth more than $10,000, even if they never added another dollar. Using the upper range is the more honest representation of current ownership. Keep that context in mind as we go through each fund. Now let's get into it. The first issuer on our list is NEOS, one of the most respected names in the covered call ETF space, managed by co-founders and managing partners Troy Cates and Garrett Paella. NEOS currently manages 10 ETFs that show up in the Morningstar ownership database, and between them, Troy and Garrett have put a combined total of approximately $510,000 of their own money into the funds they run. Let me walk through each one. SPYI, NEOS's S&P 500 high-income ETF, is the flagship fund for NEOS, currently carrying approximately a 12% annual distribution rate and managing over $6 billion in assets. The Section 1256 index option structure that delivers the fund's tax-efficient income is the core of what makes NEOS distinctive in the covered call space. Troy Cates owns approximately $10,000 in SPYI. Garrett Paella owns approximately $50,000. BTCI, NEOS's Bitcoin high-income ETF, one of the first covered call products in the Bitcoin ETF space, shows the same pattern. Troy at approximately $10,000, Garrett at approximately $50,000. QQQI, the NEOS Nasdaq 100 high-income ETF, is where things get slightly more interesting. Both Troy and Garrett own approximately $50,000 each. meaning both co-founders have committed to the fund's full $50,000 disclosure tier, making QQQI the NEOS product with the most balanced ownership between the two partners. QQQI currently yields approximately 13.9% annually and has attracted over $6 billion in net inflows in 2025 alone, reflecting exceptional institutional and retail confidence in the strategy. IWMI, NEOS's Russell 2000 High-Income ETF, shows both Troy and Garrett at $10,000 each, the lower ownership tier, which makes sense for a newer and smaller product. CSHI, the Enhanced Income 1-3-month Treasury Bill ETF, a cash management tool rather than an equity income product, lists Troy at $10,000 and Garrett at $50,000, a reasonable allocation for a product designed more as a yield-enhanced cash equivalent than a core portfolio holding. The most notable ownership figure across the NEOS lineup comes from QQQQH, the NEOS NASDAQ 100 Hedged Equity Income ETF, which is the defensive version of the core NEOS strategy designed to limit drawdown during market corrections. Troy owns approximately $10,000 in QQQH, and Garrett owns approximately $100,000, the highest single-fund ownership figure in the NEOS lineup, and a meaningful signal that the co-founders have genuine conviction in the hedge product specifically. When the person who designed a fund commits 6 figures of their personal capital to it, that is a qualitatively different signal from the lower-tier disclosures. TLTI, the Enhanced Income 20-plus Year Treasury Bond ETF, shows only Troy's ownership at approximately $10,000. Garrett has no disclosed position in TLTI, which is notable as the only NEOS product where the co-founders are not both invested. BNDI, the Enhanced Income Aggregate Bond ETF, returns to the familiar pattern. Troy at $10,000 and Garrett at $50,000. HiBI, the Enhanced Income Credit Select ETF, shows both partners at $10,000. And the final NEOS entry is IYRI, the Real Estate High Income ETF, where Troy owns approximately $10,000 and Garrett has no current disclosed position. Adding up all 10 NEOS ETFs across both founders, the total combined ownership is approximately $510,000. That is $500,000 of the founders' personal capital invested in the products they manage. For a firm of NEOS's size and the personal wealth likely available to two managing partners of a multi-billion-dollar ETF issuer, $510,000 may not sound astronomical, but it is real money. It is disclosed, it is publicly verifiable, and it clearly indicates that both founders have meaningful financial alignment with their investors. The next name on the list is TAP Alpha, and this is where the ownership numbers take a significant jump. TAP Alpha's funds are managed by founder and CEO Cy Kiran, and the flagship product is TESPI, TAP Alpha's SPYI Growth and Daily Income ETF. TESPI uses a daily income distribution strategy on the S&P 500 and is one of the more distinctive products in the income ETF space in terms of its distribution frequency and mechanism. The Morningstar database shows Cy Kiran's ownership of TESPI at over $1 million. I'd want to one for Dan and Pato. Salpredendards. The top disclosure tier, and to put a concrete number on what that means in practical income terms, at TESPI's current distribution rate, a $1 million position would generate approximately $146,000 per year in distributions. That is not a theoretical number on a marketing slide. That is the CEO of TAP Alpha collecting $146,000 per year in dividends from his own fund. If that is not eating your own cooking, I genuinely do not know what it is. The TAP Alpha disclosure is the most compelling ownership story on this entire list because of both its size and its specificity. $1 million plus personal investment in your own income ETF, generating 6 figures annually in the very distributions you are telling your investors to expect. That is about as direct an alignment of interests as the income ETF space has ever produced. JP Morgan is the largest and most institutionally established name on today's list, and their ownership figures reflect the scale of the organization. JEPI and GPQ are managed by a team of 4, Hamilton Reiner, Zhidong Chen, who I will call Z throughout, Judy Jansen, and Matthew Benson. The combined ownership across both funds and all 4 managers is approximately $4.3 million, making the JP Morgan team the single largest collective owner of their own products on this entire list. Let me break JEPI down first. JEPI, the the JP Morgan Equity Premium Income ETF, is one of the most widely held income ETFs in the world, managing approximately $41 to $43 billion in assets as of early 2026. It carries a Morningstar Silver Medalist rating, which is a meaningful quality distinction in the fund research world. Silver means Morningstar's analysts have high conviction the fund will outperform its category peers on a risk-adjusted basis over a full market cycle. Hamilton Reiner owns over $1 million of JEPI personally. Z owns over $1 million as well. Matthew Benson owns approximately $100,000. And Judy Jansen owns approximately $100,000. That is a combined GP management team ownership of approximately $2.2 million in a single fund. GPQ, the JP Morgan Nasdaq Equity Premium Income ETF, tells a similar story. Hamilton Reiner has over $1 million in JEPQ. Z has approximately $1 million in JEPQ as well. Matthew Benson owns approximately $100,000, and Judy Jansen owns approximately $50,000 in JEPQ. Combined JEPQ ownership approximately $215 million. Total across both JP Morgan products, approximately $4.3 million. And to give that number a real-world context, at the blended yield of JEPI and GPQ, roughly 7 to 8% for JEPI and 10 to 11% for GPQ, the JP Morgan management team is earning approximately $413,000 per year in distributions from their own funds. That is an extraordinary alignment of financial interests. The people running these products are not just collecting fee revenue from your investments. They are themselves investors in the funds, receiving the same distributions you receive, experiencing the same NAV fluctuations you experience, and sharing the same stake in whether the strategy performs. It is worth noting that JP Morgan's ownership figures are the most impressive on this list in absolute terms, but they also need to be contextualized by the scale of the institution and the likely personal wealth of senior portfolio managers at one of the world's largest asset managers. $1 million in personal fund ownership for a Hamilton Reiner, who is one of the most prominent names in the entire options income ETF space, is a different proportion of personal wealth than $1 million ownership stake from a founder of a boutique ETF issuer. Both demonstrate commitment, but the commitment means something slightly different in each context. What is unambiguous, in both cases, is that these managers do own their products, they own them meaningfully, and that ownership is publicly disclosed and verifiable. The fourth issuer on our list is SPYI, whose income ETF lineup is managed by portfolio managers Kevin Simpson and Josh Smith. SPYI runs 3 covered call and dividend income products that appear in the ownership database: QDVO, DIVO, and IDVO. QDVO, SPYI CWP Growth and Income ETF, shows Kevin Simpson owning approximately $50,000 and Josh Smith owning approximately $10,000. DIVO, SPYI CWP Enhanced Dividend Income ETF, shows the same pattern: Kevin at $50,000 and Josh at $10,000. IDVO, SPYI CWP International Enhanced Dividend Income ETF, adds a third manager to the disclosure, with Timothy Seymour also owning approximately $10,000, alongside Kevin's $50,000 and Josh's $10,000. The combined SPYI team ownership across all 3 funds is approximately $190,000, not the headline number that JP Morgan or TAP Alpha produce, but consistent across the entire product line, with both primary managers invested in every single fund they run. The final 2 funds on today's list come from smaller issuers. X Funds is managed and owned by David Nicholas, and GX, the Nicholas Global Equity and Income Fund, shows David owning approximately $50,000 of his own product. A founder managing a boutique fund with $50,000 of personal capital invested signals genuine commitment at a scale proportionate to the size of the operation. The 18th and final ETF is NIG by First Trust, where portfolio manager Karen Sood holds approximately $10,000 in the fund. First Trust is a large diversified ETF issuer with many products and many managers, so a single manager's $10,000 disclosure needs to be contextualized against the breadth of the organization. But the ownership is present and verifiable. Now let me give you the honest context that makes all of these numbers meaningful rather than just a recitation of data. The funds that appear on this list, SPYI, QQQI, JEPI, GPQ, TESPI, DIVO, QDVO, share something important beyond their manager's ownership. They also share a track record of not destroying NAV. This matters enormously in the income ETF space because the single most important question about any high-yield fund is not the distribution rate. It is whether the distributions are being paid from genuine investment income or from the gradual return of your own principal. A fund paying a 15% yield by slowly liquidating its NAV is not generating income. It is executing a very slow, very structured return of your own money with a pleasant monthly cadence. The funds whose managers do not appear in ownership databases tend to share a different set of characteristics. Their charts do not look like the ones I just described. They look like long, slow descents, a distribution that looks attractive on launch, followed by months and years of NAV that gradually erodes until the yield percentage stays high, but the absolute dollar amount of each distribution has declined along with the price. The managers of these funds do not own them because they understand exactly what the chart is going to look like over time. They built the product, they know the mechanism, and they know that the investors who buy it will eventually realize the headline yield is not what it appeared. That is not speculation, it is the logical inference from the data. The managers who own their own products are the managers whose products are worth owning. The managers who do not own their own products are telling you something important, even if they are not saying it out loud. The one caution I want to add to everything we have discussed today is about the inverse mistake. The fact that these 18 funds have managers who eat their own cooking does not mean you should pile all of your capital into any single one of them. Every income ETF, ETF, including the excellent ones managed by people who own them, involves trade-offs. JEPI and GPQ cap upside in strong bull markets and have lagged pure equity funds significantly during 2023 and 2024's technology-led rallies. SPYI and QQQI use Section 1256 options for tax efficiency, but the structures are more complex than simple index funds and require more due diligence. SPYI pays daily distributions, which sounds appealing, but requires careful examination of the NAV impact over time. Ownership by the manager is a necessary condition for confidence. It is not a sufficient condition by itself. You still have to understand what the fund does, what it costs, and whether its specific income and growth profile matches what your portfolio actually needs. The broader framework here is one of alignment. In any financial relationship, whether with a fund manager, a financial advisor, or any professional who manages money on your behalf, the question of whether their interests are aligned with yours is the foundational question. Skin in the game is the most direct, most concrete, most verifiable form of alignment available. The 18 funds we looked at today, and the managers behind them, have passed that test. The combined total personal ownership across all 18 ETFs and all the managers we reviewed is approximately $5 million. That is $5 million of the people who built these products sitting alongside your money, experiencing what you experience, collecting what you collect, and losing what you would lose if the strategies fail. That alignment is worth something. In a space full of products designed primarily to generate fee revenue for issuers rather than returns for investors, it is worth quite a lot. If this breakdown gave you a more useful lens for evaluating income ETFs, hit the like button and subscribe. I cover the covered call and income ETF space in depth with a focus on the data and analysis most people skip. Drop a comment with the income ETF you own and whether you have ever looked up whether the manager owns it. I read every single comment. I will see you in the next one.